So there is not a single doubt that the US S&P 500 index has been the benchmark for most investment portfolios, and that makes it a very easy investment recommendation for most investors out there thanks to its phenomenal historical performance for the past few decades. However, as a fellow investor that talks about investing in the US market a lot, I do believe that we as an investor need to recognize the potential risk of our investments rather than just looking at its reward, because like it or not, risk and reward are all part of the game, which is why in this video I will be sharing with you 3 main risks that may or may not jeopardize your investment in the US market. And to be more specific, the S&P 500 index. Though just to make myself clear, I'm not saying this to spark fear or whatsoever, but more so to provide you a contrarian view just so you are better informed with all aspects of your US market investments. Before we begin, it helps a lot if you can smack the like button down below for me. Thank you very much. And without further ado, let's dive right into it. The first risk you should know about is the US Fed's aggressive rate hike, which they project will hit about 2.5% by the end of 2022, and that is well above the 1.5% rate that we have before COVID-19 started, or even more than the 0.25% that we have right now. Even the Fed officials themselves acknowledge that a series of rate hikes over the coming months could tip the US economy into a mild recession, and the rising mortgage rates are causing more home sellers to lower their asking prices due to the lower demand. And I myself am also looking to purchase a property in Klang Valley, and seeing the difference between a 2.9% interest rate mortgage versus a potential 4 to 5% interest rate in the coming years, that just doesn't help at all for my future cash flows. But anyways, all of that essentially shakes the market because the US has been in this near zero interest rate environment for the past 2 years due to the excessive quantitative easing, which also resulted in the current 40 years high hyperinflation environment. That's important because if you look at the sector diversification of the VOO ETF that tracks the S&P 500 index, they have a relatively small exposure to energy and commodity, which historically thrives better during a hyperinflation environment. But of course, that alone will not be able to topple the S&P 500 index because we also have the ongoing Russia-Ukraine conflict that drives up the commodity prices, the Shanghai COVID lockdown that worsens the global supply chain, and the US labor shortage that inflates the wage price out of control. Wow, what a time to be alive. Anyways, long story short, all of those factors contributes to the hyperinflation, which consequently trigger a much hawkish Fed that would mean more interest rates hike in a very short period of time. And boy, I don't think many businesses worldwide, not just in the US, will be able to survive this. If you don't know what I mean, feel free to check out this video where I explain it in detail. And backtracking a little bit, remember we just touched on the quantitative easing early on in this video, which the US literally printed a fifth of its US dollars in 2020 alone. That has profound impact on the Fed's balance sheet, which is the reason why they are now underway to reduce it by $95 billion a month. And that doesn't help at all when the US Congress just approved a $1.5 trillion spending bill, which will further increase the budget deficit. What do you do when you need more money to fund your spendings? You borrow more money, simple as that. Now the question is, how would the significantly balloon amount of federal debt trigger or cause a potential collapse of the US dollar? Well, according to the Congressional Budget Office CBO, the persistently rising debt as a percentage of GDP would pose significant risk to the fiscal and economic outlook, a situation in which investors lose confidence in the US government's ability to service and repay its debt, causing interest rates to increase abruptly, inflation to spiral upward, or other disruptions, and it will increase the likelihood of erosion of confidence of the US dollar as an international reserve currency and more difficulty in financing public and private activity in international markets. In short, when investors lose confidence in the US dollar, for sure they will look for the next best currency, right? So let's take a look at who can dethrone the US dollar. According to Investopedia, as of March 2022, the IMF approved 4 other reserve currencies: the Euro, British Pound Sterling, Japanese Yen, and Chinese Yuan, which means either 4 of those currencies may be the runner-up after the US dollar. If you look at this weightage, the Euro follows after US dollar, but with the recent Russian-Ukraine conflict that triggers a potential oil crisis in Europe, it would be a safe guess to eliminate Euro from this list. And the Pound Sterling? Let's just say the uncertainty brought by Brexit makes it nowhere close to being a stable world reserve currency at the moment. That means the remaining possibility would be the Chinese Yuan and Japanese Yen. Now, I'm no expert or economist, but if you ask me, I would say only the Chinese yuan would stand a higher chance in achieving that. But then again, in order for that to be even remotely possible, I would say it's a combination of a few worst case scenarios, such as the uncontrolled hyperinflation that drags on for a long period of time, the inability of the US government to shrink its balance sheet, or when they start defaulting on their bond coupon payments, or when businesses start to leave the country. Then I would say if that time comes, trust me, you will definitely know it from all the news outlets. Not to say it's impossible, but that seems like a long shot to me. And even if indeed the US dollar is close to collapse, do you think China and Japan, as the top two countries that hold the biggest amount of foreign currency in the form of US dollar and euro, will let that happen? I believe you should have a better idea by now. The third risk you should also know when it comes to investing in the S&P 500 index is that it is currently trading at a record high valuation. One of the most common ways to value the index is through the Shiller PE ratio, which is technically a PE ratio, but using inflation-adjusted 10 years earnings data instead of the short-term earnings data. Traditionally, the ratio averages around 17 for the past 100 years, and for the recent decades, they average about 25. And FYI, today the ratio stands at the high 30s as of the recording of this video. And also FYI, the ratio usually spikes up significantly higher before market crashes. But for what it's worth, we are technically trading way above its mean right now. That said, there is no one ratio that can technically tell you that a market is overpriced or not, but obviously by just simply looking at the S&P 500 index against its 200 days moving average, anyone will be able to tell that the stock market is overpriced on paper. And that is supported by Robert Shiller's theory of mean reversion, which says that the asset price and returns will eventually revert to the long run mean or average level, or in other words, what goes up must come down, and vice versa. Apart from the Shiller PE ratio, index investors also commonly look at the ratio of the US total market cap to GDP, aka the Buffett indicator, and from this source it shows that the market is technically 50% above the historical average, suggesting that the market is significantly overvalued. While we all love and respect Warren Buffett, this indicator does come with its flaws as well, since it only looks at the market cap of the companies and doesn't take into account the profitability of the businesses. And in my view, the new trend line that indicates the fair value should be adjusted to accommodate the significant increase in the cash in circulation in the current US economy. But then again, who am I to say that, right?
So Ziet, this cannot, that cannot, so what should I do?
Well, the point I'm trying to make in this video is all investments come with risk, and even with the S&P 500 index that historically brings a steady 8 to 10% per annum of return, there is still an element of risk attached to it, because if there is no risk, then it wouldn't be considered as an investment and you are better off just storing money under your pillow. And even that, you are risk losing your money's value to inflation. Kind of a tough situation to be in, right? But anyways, I do think that it is totally fine to take on some calculated risk with your investments, especially with the S&P 500 index, just because the requirements for it to fail would be a failure of the US government on top of the collapse of the US dollar, plus some element of world war, and at which point your money in any other currency or market would equally suffer from a drawdown. For the market trading at a historical premium, that is a legit concern. But considering almost everyone, regardless of the rich or poor, or professionals or beginners, now have access to an investment account to invest locally or abroad, we are bound to have more liquidity in the system, which also means more volatility and higher valuations because of higher demand. And to be honest, I don't think the market is able to properly price that fundamental change, or should I say shift of the way how stocks are being valued yet. I, for the most part, would just recommend you to dollar cost average, especially in these uncertain markets, because time in the market beats timing the market. Okay, I hope you found some value from this video. Like and subscribe if you want more content like this. And with that said, thank you very much for watching. Stay safe, stay invested, and as usual, I will see you in the next one.